So, welcome students. Welcome in the class of Financial Management and Cost Accounting. And today's topic is the concept of balance sheet. So, you know, financial accounting, relates with recording the financial transactions and then analyzing, summarizing, and presenting it to the users. So, we have accounting and we have learned various concepts of accounting so far. And then the final outcome of the financial accounting is, the accounting cost accounting is balance sheet, trading account, and profit and loss account. So these three are the final outcome of the cost accounting. So today we are going to discuss about the concept of balance sheet. So far we have studied about the concept of journal, posting in ledger, then trading account, and then preparing a trial balance. So after preparing a trading account, we prepare trial balance, and then the next is balance sheet. So trading account gives us the information about the gross profit and gross return. You know, gross profit means the value of sales, net sales, minus the cost of sale, cost incurred on selling those products. But there, so it includes all direct costs and direct revenue. But there are some indirect costs, indirect expenses, and revenue from other sources also. So in profit loss accounts, we take all those items and then it gives the net profit and net loss. So we have discussed all these things so far, and today we are going to see what is a balance sheet. So a balance sheet is prepared from the real and personal accounts. Please remember, please recall what is a real account and what is a personal account. A real account is the account of an individual or the business entity. So it relates to individual or the business of the individual, and both are considered separate. So the proprietor is separate from the business, and the business has its own account and the proprietor has its own account. Then second account is the real account, which includes assets, which includes tangible and intangible assets, right? So we have real accounts here and personal accounts here, and the records of the nominal account goes to profit and loss accounts. So balance sheet includes only the records, the transactions which are entered in the real account and personal account. The balance sheet summarizes the financial status of a business at a point in time. It is very important to understand that it gives the financial status of a business, financial condition of a business at a particular point in time, as on date. If it is prepared today, so it gives the financial status of that business for today. What is the condition? What is the status of this business today? Because every transaction affects the balance sheet. If a new transaction is made, then the balance sheet will change. So it is always prepared on a date, as on a date at a point in time. So it is always meant as on 31st March 2020. So it is written on the in the heading, and it contains summary of assets. So a balance sheet contains the summary of all assets, liabilities, and then also has owner's equity. Owner's equity is the investment made by the owner, and it is the difference between the liabilities and the, what is next? Can you tell me, anyone? Assets. So we have assets and we have liabilities, and when we deduct the liabilities from the assets, what remains is the owner's equity. Suppose a business liquidates all its assets and pay all its liability. What remains is the owner's equity. That is why it is considered as the financial status of the business. It estimates net worth of owner's equity. Owner's equity is also known as net worth. And most transactions affect the balance sheet, and thus it may change every day. I have already told you that any new transaction can affect the balance sheet, and thus it can be prepared at any time. But usually it is prepared at the end of an accounting year or financial year, that is on 31st March of any year, financial year. Then what is the purpose of a balance sheet? It is very important. If we prepare something, some statement is prepared, so it has certain purpose. And a balance sheet is also prepared for a particular purpose. And the purpose is to provide information on financial status or condition of a business at a given date point in time. So I have already told you that it is the indicator of, it gives the information about the financial status or condition of a business at a given point in time. So it includes everything that is owned. Anything which has value and which is owned is known as assets. You know, we have already discussed, we have already given you these terminologies in the previous classes. So asset is anything which has value and which is owned by us. That is called asset. And anything which is owed to the outsider, by the business, is a liability. Suppose I have rupees 10 lakhs, out of which I have borrowed rupees 2 lakhs from Amar, say Amar. So I have with me rupees 10 lakhs, but out of that rupees 2 lakhs is borrowed. So what is owned by me? My own is 8 lakhs and 2 lakhs are borrowed, means I have to pay that. So if someone make a decision that I have the property, I have in my possession rupees 10 lakhs. So it is not the right indicator, because out of that 10 lakhs, only 8 lakhs is mine and 2 lakhs is liability. I am liable to pay to the person Amar from which I have borrowed. So my worth is only rupees 8 lakhs. So this is my owner's equity, this is my worth. Just reverse this. Suppose I have in my possession rupees 10 lakhs, out of which 2 lakhs I have invested is my own, and 8 lakhs I have borrowed from other sources. So although I have in my possession rupees 10 lakhs, but what is my worth is? My worth is only rupees 2 lakhs. Assets minus liability. So I incur more liability than my assets, and thus on the basis of this this balance, means the owner's equity, one can easily judge, one can easily understand that I am overloaded with the debts. I have more liabilities than the assets, and this is the advantage. This is the advantage of the balance sheet, that it gives the financial status where you stand as a proprietor, as a owner of the business. So it gives the owner's equity, and that is why we prepare the financial statement, and of that we prepare a balance sheet. Then liabilities are any debt, I have already told you, or financial obligations owed to someone else or outsiders. So anything which is owed to outsiders, which is to be paid to outsiders, is a liability. It is the owner equity that matters, because it is the actual it is the actual indicator. It gives the actual status of the business, where the owner stands. What is in the hands of owner? What is actually there with the owner left? So that is the owner's equity. That is the net worth that matters. Owner's equity or net worth is the amount invested in the business by the owner or proprietor. So it is the current, it is the existing investment in the business. And owner's equity is estimated, calculated by using the formula. Owner's equity is equal to total assets minus total liabilities. So if we go for analyzing the owner's equity, estimating the owner's equity, then it can be obtained by the balance of total assets minus total liabilities. Then preparing a balance sheet. A balance sheets are mostly prepared at the end of the financial year or an accounting period. We have already discussed. And in India, you know, the accounting or financial year starts with 1st April to 31st March. So it is the end of 31st March is the end of financial year, accounting year, and thus most of the balance sheets are prepared on 31st March. Although it can be prepared anytime if required, because any financial transaction, new financial transaction affects the balance sheet, and thus to judge the status of the business on a particular date, it can be prepared at that date also. It represents both end of the year and beginning of the year. So when we go for preparing a balance sheet, and you know, so it contains the information of the previous year as well as the this year, current year, and this is to compare. The purpose is to compare, to do the analysis, comparative analysis. Then general format of a balance sheet has assets and liabilities. It has two sides, usually assets and liabilities. Liabilities are written on the left side. I have written here assets, but in a traditional form, you will find that liabilities are written on the left side, and all the assets are written on the right side. Assets includes current assets and non-current assets or other assets. So you know current assets, we have already defined, we have already learned the definition in the previous class where we are discussing about the basic terms of the accounting. So current assets are those assets which are generally utilized within a year, which are kept for the use for liquidating within a year. So all goods produced which are available for the sale are current assets, cash, current assets. So we have current assets, and then there are other assets that are there which are included in the assets. Then we have liabilities, and liabilities are also of two types: current liabilities and non-current liabilities. So current liabilities are those which are to be paid within a year, and non-current liabilities are those which can go beyond an year also. And then the difference is the owner's equity. That is the difference between the assets and liabilities. Using the formula shown in the previous slide, we can estimate, we can calculate the owner's equity. And total liabilities and owner's equity, total liabilities and total owner's equity is equals to what? Please remember the following formula, last formula. What was there? Owner's equity is equal to assets minus liability. So what is left? If we take the liabilities towards the owner's equity, if we add the liabilities in the owner's equity, so what remains is the total assets. So we may have a total assets worth certain amount, but it may include what? Those which are owned by us and those which are borrowed. So owner's equity is a liability for the business because it is on it there is a claim of the owner. So the owner invests to get return from his investment. That is why owner's equity is considered a liability for the business. Then assets can be sold to generate additional income. These are the properties of assets, that it can be sold to generate additional income. Current assets are the goods which have already been produced, which are available, which can be sold quickly without disrupting future production activity. So, without disturbing the future production activity, all those items which have already been produced and which are available for the sale and which can be sold quickly are current assets, like grain, cash, milk produced. So these are current assets which can be produced after the production immediately. Then non-current assets and other assets, machinery, equipment, building, these are the non-current assets which generally goes beyond the year. Then you have already seen these classification in the terminology. We have fixed assets. So fixed assets have long life, and more than 1 year. Its services are utilized for more than 1 year. Acquire and help permanently in the business. They are used for purpose of earning profits, and they are not for sale as far as land, machinery. So we generally make a plant, establish a plant. This is a fixed asset, and it is established to go for the production, to run the business, to start the business, to pursue the business activities. So these are invested for the long term. Then tangible assets, which can be touched, which can be seen. Then we have current assets. These are assets which can be converted into cash in a short period of time. As far as cash at bank, debtors, investments, these are the current assets we have already discussed. Then we have fictitious assets. Those are assets. Those are not legal assets and are fictitious in nature. These are unwritten losses. Sometimes there are losses that we don't divulge, don't disclose. So unwritten losses, share of debentures, heavy advertisement expenses. When we go for advertisements, we make heavy investments. So these are all fictitious assets to promote the business. All such expenses have debit balance and are to be written off through, और इसको write off कर दिया जाता है. And then vesting assets which are consumed fully in the process of production. So we have already discussed this. Once coal has been taken out from mine, new coal could not be generated. So mine is treated as vested assets. So we have different kinds of assets. The liabilities. Liabilities are obligations. An obligation to outsiders claim. It is not to outsiders claim or outsiders claim. So liabilities are obligations or outsiders claim on which which is to be paid to the outsiders. So owner's equity is a liability for the business and it is to be paid to the owner. So it is also a type of liability. Then we take debt, we take money from others, we borrow money from others. So that is one of the liabilities because we need to pay that. And it is also of two types: current liabilities that need to be paid within a year, like accounts payable, principal and accumulated interest on a short-term loans. Sometimes we take loans and then we need to pay the interest on the loan as well as the principal amount that is to be paid within that year. So these are the current liabilities. And then non-current liabilities which are not required to be paid in full within the year, which that goes beyond the year also. Then we have owner's equity, and this is very important. The amount of money remained or left with the owner if the assets are disposed of and all liabilities are paid are the owner's equity. That is the owner equity. That is the amount left with the owner. So it is the owner's equity in which owner has interest, and the owner always tries to increase his or expect that there is an increase in his equity, net worth of the business. So this is net worth or owner's equity. It is the balance left after deducting the total value of liabilities from the total value of assets. And it is also called the net worth. It depicts the owner's existing investment in the business. So if today a balance sheet is prepared, so it shows the owner's equity shows what is his investment as on today, that day. So it shows the existing investment. Owner's equity equals to total assets minus total liabilities. We have already discussed in the previous class. So this is the basic concepts involved in the balance sheet. We will do certain exercises on balance sheet and profit and loss account in the next class. So I will show you some slides in the next class on balance sheet and give you some examples. So please remember that we prepare financial statements. Financial statements are the statements that shows the financial position of the business during an accounting year and at a given date of time. So profit and loss trading account, this shows the profit and loss during an accounting year, over the year, in the year what the business has and how the business has performed. Whereas the balance sheet shows the status of the business as on date. Today, if it is prepared today, so it will show that today where the business stands. What is the owner's equity? What is the net worth of the owner as on today? So it is always prepared as at a given point in time. Then please remember that trading account gives gross profit and gross loss. It shows the gross profit and gross loss. Gross profit can be presented in the form of an equation, and that equation is gross profit is equal to net sales minus the cost of goods. So if the goods sold, if we take the net sales means if 100 items are sold, so the revenue received out of that is the net sales, amount of net sales, and out of that, if we reduce the deduct reduce the cost of the sale, then it gives the gross sales. So it includes direct revenue and direct cost. Then the profit and loss accounts shows the net profit and net loss, and it is estimated by using the gross profit minus indirect expenses. So we take we have gross profit, and then out of that we deduct the indirect expenses. And in gross profit, we also add the profit earned from the other sources. So, like we have some money in the bank, in the deposits, so we earn interest on that. This is not the income from the business, but this is a profit for the business, and that is why we add this profit, this interest in the gross profit, and then we deduct the indirect expenses and indirect costs. So this gives the net profit and net loss, and that is and to know that, we prepare the profit and loss accounts. And then the third statement is the balance sheet, which is prepared to know about the status of the business at a given date, at a given point in time. It gives the financial position of the business. It shows the solvency of the business. If the net profit, if the net worth is more, if the net worth is positive, then we will say that business is solvent. If the net worth is negative, it means the business has gone insolvent, means liabilities are more, and then assets are less than the liabilities. So this is all for today. Thank you very much for your presence listening, and we will see some examples on this in the next class. Then tomorrow I will take a class that relates to entrepreneurship development that I took in the previous class, but some of the students left. They were tired, I know, so I will again take that class, including some more slides, so please be there. And please do prepare the assignment that I have given. Please discuss among yourselves. If some person is not aware of that, please inform them and then submit it, so that I have this in my hand. And these are the items where I can help you. If I have an assignment, so then while going for evaluation or at the end of the examination, I can help you. So please do prepare assignments and send. Thank you very much. Thank you very much. Thanks to all.
Thank you, sir.
Thanks.